Good morning, everyone. Welcome to Admiral Markets. My name is Chris. Today's last webinar on strategy using Fibonacci and waves. Before we take a look at this topic, though, be aware of these disclaimers. First, that this webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity for more details. Secondly, also please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty, so let's take a quick look at the calendar as always, just to get an idea about what could be around the corner. You want to be aware of these news events. You see, for instance, the GDP rate in Australia, pretty strong, 2.4. Those are events that can impact price action in the market. So you want to be aware of those when those take place and take action or not action, depends, of course, on your view. But you want to be aware of them at least. This is basically today showing an unemployment rate for Germany, unemployment change for Germany. We have some pound news as quite typical, of course, as well. Coming up, PMI, for instance, could be an interesting figure. Inflation rate for Germany. In the US, we have PMI manufacturing, and in Canada, we have the Bank of Canada interest rate decision, probably staying at 0.5% there. So those are just a couple of things you want to be aware of. Other things you can do, of course, on the website are, for instance, this heat map. Let's take a quick look what the top movers were. New Zealand, a pretty big one here, as you can see. And some stocks to the downside and upside. Regarding currency pairs, let's see. We got pretty good movement on the Swissy here, CAD Yen, Pound New Zealand, Euro CAD. Some untypical pairs, in fact. Let's take a look at the currency ranges. And we can see that the CAD itself was quite strong mover. That's untypical. Typically, that's the pound. It was in the top 3, but not the biggest of them all. Actually, there was the CAD in New Zealand. That's a bit exceptional day. USD was also quite strong, and slow movers relatively Euro, Aussie, and Swiss franc. So that's useful information besides, of course, what we typically look at daily wave analysis, technical and fundamental. I want to take a look at wave analysis today because this is a Fib and wave webinar. For the last 6 or 7 weeks, we've been looking at Fibs and waves, and this is kind of the last of them all. So I wanted to wrap it up, connect them in a way. And you can see when looking at my wave analysis that often I have both on the chart. I have 1 or 2 Fibs, sometimes 3 because I don't want to overcomplicate things. You can really add many Fibs to see where the confluence lies. I don't do that because the chart just becomes messy. As a presentation to you, to others that are looking, it might become too messy, too not so readable. So I typically choose the Fib that I find the most value, the most interesting, the most important. So, but typically you always see at least 1 Fib, sometimes 2. So when looking at the euro dollar, you see, for instance, in today's live market action that price has broken through the support trend line indicated by the dotted blue, for instance, and that could have completed the wave 2. So it is possible that wave 2 has been finished. We have a WXY blue, a 3-wave correction as I expected. That did indeed occur. The tricky thing sometimes is when is the correction really finished? And that we can measure by the reaction of price towards key support or resistance levels. And price has signaled that it broke through support. So that could be one important clue that wave 2 is finished. But it's not the only clue. The horizontal bottom, the green line at wave X, should be broken too. That is the final confirmation of the wave 2 completed. So as price breaks through that bottom, then I would place the purple wave 2 on top and indicate that that means that, the wave structure there is most likely completed in my view. So I think there's a good chance it's completed. I still left it open. There's the three-wave pattern has happened. Now we just need that final, this is the first step. Now we need that second step to occur. If price breaks through that green line, breaks through 105, goes below it, there is a good chance the price is in a wave 3. But that also remains to be seen. I think that there's a good chance that price will fall down to test the bottom at 104 and 103.50. But how will price respond at that support zone? That would be the next question, the next big question. If price bounces there strongly, then this is not a wave 3. If it's weak reaction and a continued break below it, yes, then there's a good chance it is a wave 3. So that's how basically I update my waves analysis as I get continuous information about momentum and correction. That's one thing. Support and resistance, the second, and third, patterns. By connecting those three things together, I get let's say, the most likely path of least resistance that price will probably use. And momentum indicating, of course, if it's strong, that price could be in a trend and therefore break through support or resistance. Patterns within that trend could indicate that there could be a continuation. So this is how, or if there's a strong confluence that could stop the trend from continuing. So I try to kind of factor in all these three things and then make my overview of the market. Now let's take a look at the hourly chart. I still have an ABC, but if price breaks through that green line, then this will become a 1, 2, 3 green rather than an ABC green. Pound dollar, big triangle, first broke to the upside, now breaking to the downside as expected because of the bearish momentum that we saw. That I marked it as wave 1. I marked this as a retracement for wave 2. And now that they broke through the dotted line and the horizontal bottom at wave 1, this could be a wave 3. Now, for the moment, bearish momentum is visible. Price broke, pulled back, continued. How far that continuation will last, that remains to be seen. It really needs to fall below 122.50 for this to be a strong wave 3. If it doesn't, then it could just be still a correction. So that would be the next confirmation level of whether this is a wave 3. Pound dollar 1 hour chart, you see the wave 2 stopped at the 50 fib, ABC correction within the 50 to the 50 fib. Price breaking below support. Now it could be building a wave 1, 2, 3. Dollar yen, I for a long time marked the blue line as a key invalidation level of this blue wave 1, 2. 5 wave up, 3 wave down. I was pretty confident that this was a wave 1, 2 because of that structure, that internal structure. And indeed, price didn't invalidate, bounced off my level just barely, but it didn't break it. That's the most important. And therefore, hence, this is still valid. And indeed, price moving pretty sturdily from that zone. Now, all of this price action probably connected to the speech of the U.S. president. So, and this could have been some volatility connected to that. But from a wave analysis, this is what I expected, that price would not break through blue level. Otherwise, my analysis was invalidated. So the fact that it didn't break kind of confirmed what I was expecting. Now, whether this is still a wave 1, 2, that's uncertain, but what I do expect is bullishness. Whether it's an ABC blue or a 1, 2, 3, in both scenarios, this third leg should be up. Now, it depends how far it will go up, whether I'll mark it as ABC or whether it's going to be a 1, 2, 3 indeed, as I expect. I expect it to be a 1, 2, 3 because of the daily and weekly charts. It's a analysis from a higher time frame that point me into that direction. If I would only look at this 4-hour chart, it's not clear. So that's why, as we've talked about in the recent weeks, that it's important to zoom in and out with looking at wave analysis, because you can see the market structure a bit better on a higher time frame. Sometimes you can see it a bit better on the lower time frame, because I see 5 waves, therefore I think there's a good chance that this is a wave 1 or 8. If I zoom out, I wouldn't see that 5-wave structure. So you kind of see different information on different time frames. So time frame analysis, multiple time frame analysis is key. 1-hour chart, the bounce, break, bounce at the blue line, break of the orange dotted line, and this could be a continuation of the wave 3. It needs to break the red line though, break above 115, and there's a good chance that this is a wave 3. So here's some practical thoughts about the waves and fibs at this time. There we go. And you can see in the meantime that price is pushing further. Excuse me. So anyone who is looking at the market right now, let me open my drawing tool very quickly. Could be looking at this price action. Hang on. All right, there we go. And see the continued push lower. So if this is a wave 3 or C, we should see basically a continued push lower. For wave C though, there could be a bounce definitely at the minus 61.8, a strong bounce. So that's also close to this bottom. So anywhere around 105, 105.10, you got to be aware that that could be a bouncing spot, or at least a pausing spot. Now whether price will bounce there or break, that remains to be seen, and that will give us information about the wave structure as well. In the meantime, what I would be expecting or taking a look at is how this candle closes at the minus 272 target. If it's a close in the low, if it's a close that this is a strong candle, but yeah, we just got the close. Good. So this is a strong bearish candle. Therefore, I think more continuation is likely, and it could be good to wait for small 5 or 15-minute bear flag, for instance, like this, and a break could be a continuation down to 105. There's not a lot of space. This price is already at 105.40, so there's not a ton of space. There's only a 30 pip move there, so it would be good to see a bit more correction like that, and then a break below this flag. When you're in wave 3, then typically the best way to tackle that is by zooming in and waiting for corrective patterns and to trade then the break. Because wave 3 or even a wave C are typically quite fast. If you didn't catch the turn, if you didn't, for instance, trade this break here or the pullback or even the double top, then those were entries that could have been possible, of course. Then you're good, and the trade is on the way. If you're not in those trades, then now you're getting into a zone where it's a bit iffier to trade, because if you look at the risk, if you put the stop loss here or up in here, and the potential reward before price might bounce, it's not looking that attractive anymore. And that happens. You have decision moments. If you miss those decision moments, then sometimes price gets into a spot that it becomes less attractive. It might be just better to wait and hold on for more information. Hold on, for instance, for price to get down to the bottom and wait for the next flag and break and take that flag, or wait for the next momentum up and take that third leg up, for instance. Now, in this case, I think there's a decent chance that both will happen, but I do expect a bearish break personally. Corrections doesn't have to be necessarily only corrections. It's possible to take an entry at the momentum, but you're looking for an area where the momentum has recently started, I think. This has already lasted a decent amount of hours, plus has already moved about 100 pips, plus support level could give it a stall. Whether it goes sideways or bounces, that remains to be seen, but there's a decent chance of that. So when you look at the reward to risk ratio equation, then this becomes less appealing, this particular situation. That's why, personally, I'm not saying going short is wrong, but there's just little space. Maybe on the lower time frame it could make sense. That's why sometimes zooming in to lower time frames, if you see strong momentum, that makes sense. If 1 hour is showing a lot of good candles, zooming into a 5-minute chart to look for smaller corrections like this makes sense. This one is very, very small and was already pretty close to the target, so I don't know. It's not a great one, I think, but it is working out. So that all depends a bit on how much risk appetite the trader has, and etc. But the point is that you can zoom into lower time frames, look for smaller patterns there as a continuation. I was looking for something like this again here, for instance, and then you can enter, try to enter a larger momentum. Try to enter, for instance, in this case, an hourly momentum after a smaller pattern has occurred on a lower time frame. If you see momentum on a 4-hour chart that has traveled already a decent distance, you can zoom into your hourly chart and see whether there are patterns available that make sense to trade still one more time, perhaps, or maybe even 2 more times before that momentum dies out and we could expect a bigger correction. So certainly either, not necessarily the very start, but rather relatively at the beginning of a momentum, it's more ideal because you could expect a push. You can get out of the risk quicker. But by zooming in like this, there is a way still to participate, even if you missed the beginning part. But be aware of support or resistance, monitor the reaction to support or resistance, or just take profit if you do that on lower time frames. So we're looking at the euro dollar from a practical point of view on this hourly chart. It all depends how price will respond to this bottom here. I expect to break. I think this is a pretty good breakout at the moment. Let me get rid of this fib. You can also zoom out to a time frame, for instance. Like if you're not sure if the hourly chart was good, you can take a look at this 4-hour candle. That's a pretty good candle. It's a candle closing at a low. So, if you had doubts about the hourly chart for whatever reason, maybe because you think it moved too much, or you're not sure what the position is of that hourly, you can take a look at the 4-hour. You can say, oh, well, there's probably just started, right? So 4-hour candles, we already have 3 of them, but it's just because it's pretty close to this bottom already, in my opinion. So yeah, that's it. It all depends on price respond here. I would expect a breakout like this and a further follow through like that. But let's see how price responds to 104 and 103.50 and 105, of course. So yes, because yesterday, for instance, the reason why I changed, because yesterday I was bullish, right? Yesterday, just a quick explanation about that. Here I was said, well, if price stays above the pivot point, if price stays above the channel, I think there's a good chance of a follow through. First to retest this top, and if it breaks that top, to go up to the 50 and probably then to the 61.8 target. Now that partially happened. It didn't break this. Indeed, the channel didn't break the pivot point. It did indeed bounce, but choppy beginning, but then made that push up from low to high about 55 pips. But it didn't manage to break the top, and then started to show pretty strong candles like this, racing down to the channel. So as the channel broke with this candle, you can see the price still bounced at the pivot point, but that was just a retracement within the breakout, partly because I think the momentum was so strong and price basically finishing that last piece of correction that I expected yesterday. It just did. I knew that it had to break above R1 before you could expect a 50 or 61.8 fib. I probably, I for sure I gave a higher chance that it would go higher. But there was always a chance, of course, that price might not get there, and it didn't. So that's why you got to keep your eyes open, your mind open, and flexible here. That although you have a target in mind, a corrective target in mind in this case, it might not get there. It might stop early, because ultimately the trend is down when you look at the 4-hour chart, right? So this upside was a correction within that, and that could be sometimes stopping earlier than we might think. So that's what happened yesterday. So over the weeks we talked a lot about waves and fibs, or first fibs and then waves. Talked about different ways of using fibs. Talked about different ways of talked about different wave formations, I should say. Are there any questions you might have at this point that you would like to discuss? Let me know over all those weeks. When looking at waves and fibs, I think it's always good to have, in my view, a fractals and moving averages, and use trend lines and the awesome oscillator. And so those are my favorite 4 things, together with the waves and fibs. Now the reason for that is because the moving averages indicate basically very quickly what the trend is. The fractals show, let me show you the fractals, 1 second. Show the trend. So for instance, here you see green fractals above the moving averages. That means that these are levels that are not strong. That means that the trend is up, and these resistance fractals are just pausing spots. The circles, however, are stronger and are indicating basically the bottom of that uptrend, right? The support levels of that uptrend, and are indicating basically that if price bounces at those levels, there could be a continuation of the trend, right? So I'm looking for retests of those circles and continuations. Whereas red circles indicate the opposite, red diamonds, sorry, indicate the downtrend, and the circles on top indicate the resistance, strong resistance, and looking for follow-through to the downside. So it's a quick visual guide, and it's basically calculated on the relationship of the fractal versus the moving averages. So a green fractal indicates that that fractal is above short and medium long-term moving average. It's above the 21 and it's above the 144. If it's a green. If it's red, it's below 21 EMA. The fractal is below and below 144. So all these fractals, this custom-made fractal that I made for myself, I don't even have a guide because I made it for myself, but I'll explain it here, is the relationship of the fractal with the moving averages. Because what I noticed was that it's not only about the relationship of price towards the moving average and perhaps the moving averages versus each other. And I don't mean in the simplistic way of what you use as a beginner, crossovers and stuff like that. No, I'm not talking about that. I'm talking about a more advanced, in a way, a more advanced way of using it. It all is, especially in the Forex market, it is a question of how price responds to this moving averages. Is it pulling away from it, right? Is it like an elastic going away from it? That can last for a while, but eventually there will be a snapback. In the Forex market especially, it's all about this relationship to the moving average. Price will move away, snap back, move away, snap back, then go in the opposite direction again. The relationship to the average is especially important in the Forex market. That is something that you will regularly see. That's why I think moving averages are important to understand not only what the trend is, But how far has price moved away from that average? How far can it still push away from that average before there's a chance that there will be a mean reversal, a reversal to the mean, or reversal to the average? All right. So that's why I thought not only the relationship of price versus moving average. I know this is, maybe for some of you getting theoretical, but hang in there. But also the fractals versus the moving averages, and that's why I made this color code. The circles, if they are blue or black, more darkish color, that means that these fractals are at the long-term moving average. And what I noticed is that fractals at the 144 EMA are critical for long-term direction. Whereas the colory circles here, orange and red, those oranges and red are really not that important. I would have to look it up what the difference was again. Well, exactly. But the lighter the color, you have to keep in mind, the lighter the color, the closer that fractal was to a very short-term MA. So those typically are less valuable because those are really fractals that are above even a short-term MA. So those are then less critical fractals. You see that here, very, very shallow fractals. Very strong push. Fractal is even above the short-term MA. So those you don't have to rely on too much. But a bit deeper color, deeper orange like this, those are already a bit more sturdier retracements. But if you get into a darker, like dark blue or black, then those are fractals that are around the long-term moving average. And those are key for the trend, I noticed. If price breaks below or above those, then typically you're going to see a new trend direction. Just as an example, I mean, this is not a perfect science, of course, but just as an example, here we had key blue, dark blue, black fractals. So price broke below that, and we had a new trend to the downside. Price retested the long-term moving average. We had a new fractal, but it didn't break, it bounced. So we had a confirmation, a continuation of the trend to the downside. So now you know the meaning of green, diamonds, and these circles. The opposite are green circles. The lighter the green, the less valuable, because they are really quite not strong resistance. Darker green circles are more resistance, a stronger resistance, because the price has retraced deeper. There are also two colors of diamonds, dark green and light green, dark red and light red orange. Dark green is indicating from a time factor point of view that those fractals are, for lack of a better word, maybe mature or ready. That means that there has been enough time factor going on that price is ready probably to continue. Where if it's light green, the time factor element is not ideal, so a break could be a bit shaky because of that. The opposite is true for the downside. Dark red means that these are good fractals for continuation of the trend, whereas light orange or pink means that any break could be a bit shaky. Yeah, just to give you an example, here's light pink and light orange, and you see the break here really didn't go too far. From a time factor point of view, the light fractals here, although they're diamonds, indicating that the trend is down, fractal price is below the long-term moving average, the time factor point of view is not ideal. Dark red indicates that from a time pattern point of view, it is okay. Of course, that doesn't mean that I should right away jump in a short as soon as one fractal gets broken, but it does mean that red diamond, dark green diamond means trend is up or down, there's a trend, and time factor element is okay. The light version means, yeah, there's a trend, but the time factor pattern is not the best at the moment. Circles indicate, so diamonds indicate the trend direction, green for up, red for down. Circles indicate the key support and resistance. Orange in this case for support, green for resistance. Might have to do that other way around, but okay. The darker the color, the more important those circles are. Lighter is less relevant. And the black, dark blue circles are where there is the key decision for the market. We can take a look at more examples here. For instance, here, let's go a bit back. Here you see darker fractals. Here too. And here. And here, and then here. So it's often a decision spot. That's the point. All right. Now, of course, there could be a triangle around the moving averages like this. So using classical patterns also helps, of course, to identify what's going on. Certainly, it's not so that to say that other things don't become important, but this is so. What does it have to do with waves and fibs? The reason is that the moving averages help a lot with identifying the waves. This is the first push through the long-term moving average. That means that this is either an A or 1, most likely. The pullback means that it's either a 2 or a B. So by looking at the position of price versus the moving averages, the long-term moving average especially, but also the 21 and the 8, gives us a bit of a feeling about the waves. In the wave 3, you'll typically see the 8 follow price very strongly like this. So that helps us identify a wave 3. If price is breaking like this through the moving average, that could mean a reversal, for instance, or a larger retracement. So that helps us identify a wave 1, 2. So by understanding the position of price versus the moving average, we have a better idea about the waves. That's one thing. I'll dive into that maybe a bit more later on. So that's how moving averages can help with waves. But the oscillator can help with waves too. I think we discussed that already. That this is a wave 1 and this is not a wave 3 because the oscillator is shorter than the wave 1. The wave 3 is the longest. So you can use the oscillator. If it is a 5-wave pattern, the oscillator should follow suit too by having the same pattern like this, with divergence between 3 and 5, but not between 1 and 3. That's how the wave, the wave with the strongest oscillator is typically the wave 3. So that's how the oscillator helps with waves too. So you see moving averages help with waves, oscillator helps with waves. The fractals help basically the relationship, are like the glue between everything. They see the trend, they help with key support and resistance levels. And they help with time factor. Time factor is important because in certain cases, things shouldn't take too long. If it is a wave 3, it's got to push. There shouldn't be too much pause. There shouldn't be too many fractals visible in a push like that. But if we see a correction, a triangle, we should see a lot of fractals on top of the bottom. So we can connect those dots, those fractals, and we should see those patterns easier. If, for instance, price is making a hook back, price is moving up, right? But this momentum, this bullish momentum is running out of steam. Time factor pattern will often indicate that, hey, there's a lack of, there isn't a break above the high. So within 5 to 6 candles, that means there's probably a bigger reversal or a bigger retracement. And the momentum indicated by blue is over. Time factor helps with that. Time factor helps recognize the start and end of swings. And swings, of course, are the basis of waves. Swings are the legs we label with waves. So with time factor, we can identify the start and the end of those waves sooner, basically. We can already do that with the awesome oscillator, but it takes often a bit longer. Sometimes one is faster than the other. With awesome oscillator, we can identify swings too. This is one swing. Why? Because the bars cross the zero line at these two spots, so that the piece between the two blue circles is one swing high, swing low. So the awesome oscillator does that neatly for us. Time factor would help us recognize here that this is, a good chance that this momentum to the upside is over this particular swing. Whether it's a correction or reversal remains to be seen, but time factor does recognize that that blue part is over. This turned out to be a reversal. And then it started to fall like this, and we then can see that this was, when it's crossed back here, that this was one piece. So both give good information about swings. That's why I like all three of them. The last one, trend lines, helps identify corrections, chart patterns, breakouts, and bounces. That's why I think these four tools are very useful for waves and fibs as an extra tool. Also, of course, the awesome oscillator and the fractals help with identifying where to put that fib. All right, so I just wanted to explain that. I see, let's see, a couple of comments and a question, I believe. Two questions, perhaps. Let's see. All right, so I see a lot of traders using, let's see, harmonic patterns, but patterns which look to me based on waves, and a lot of fibs. What are some differences or advantages of using one or the other? Good question. I'm maybe not the best to answer because I don't use those patterns. I don't use the Gartley patterns. I know Nenet does. So maybe because I don't use it because I use waves already and I use fibs already. So for me, I don't see the advantage for myself personally, but it doesn't mean that I don't think it's a good, system or useful to use for others. But because I probably already use the fibs and waves so much, I don't have any interest in just looking at those particular sequences of patterns personally. I already look at so many patterns. I look at fib patterns and wave pattern. No, sorry, I use it. Wave patterns, chart patterns, time patterns, candlestick patterns. So that's why. I think if you are a wave and fib trader, that you could still use it. I just that I don't do it. Maybe it would be too much for. I don't see the additional value of adding that to my portfolio. But I know fib and wave traders that do that. I know non-fib and wave traders that also use those patterns. That's great. If you think it's easier, then that's perfect because what they represent are waves. Just they are just some rules connected to that, which if that makes it easier for you, that's perfect, right? It's all about simplicity, finding easier ways to understand the market. So that's great. Those patterns are based on fib levels and ratios, and if that makes it easier, that's perfect. I like just to look at fibs and use the fibs based on waves. So I just use my own 272 target, minus 61.8 target, more in a discretionary way. That's why. This fractal indicator you can have definitely, and you can just send me an email right there. Let me add it. The waves also really take some time. If you're looking at full labeling or even partial labeling, it just takes time and practice and either you and it's something you don't necessarily have to do. Most important really is momentum and correction and how those respond to support or resistance, and what kind of patterns we see. Ultimately, that's the most important. The waves are an extra kind of piece of information for myself that I use. Some use it more than others. Some fully rely on it, some partially, some not at all. But one thing is certain: if you do use it, it just does take some time to get a feeling for it, and you do have to, I guess, like it so that you feel encouraged to practice with it regularly. Let's see. Yep, that's it. So that's the email if you want this fractal indicator. I mean, don't get me wrong, it's not some miracle worker, but it just, for me, provides a different level of information than the usual fractal, and helps with time patterns, support resistance, trend, just a bit quicker in my view. That's why I like it. For instance, this upside, let's take a look at that. You can see that there was a continuous push. Here's 1, 2, 3, 4, 5, 6. Sixth candle was bullish, so I needed to wait for the seventh. There was again a break of the high. So you see that, in fact, this upside, right? If you look at 6 to 7 candles not breaking this, 5 to 6 candles not breaking a high, that really only occurred 1, 2, 3, 4, 5, 6. When this sixth candle failed to break this high and the seventh candle was bearish, from a time fractal point of view, on this candle, right, there was basically the end of this particular correction from a time fractal point of view. If you look at the fractals and the moving average, you see that price failed to add dark circles there indicating key levels, dark red indicating that downtrend, and ready for a downside push as well. If you look at this particular bottom, 1, 2, 3, 4, 5, sixth candle broke that bottom as well. So those all kind of add up to understand that the correction might have been over. Now I was expecting a push within those candles to break above that, and then there could have been a chance for a further correction, and then there could have been a failure higher at 107, 107.50. But price failed to break this level and didn't, have enough steam to break above that resistance. So yeah, I wanted just to talk about the tools that help with waves and fibs. Ultimately, it's about, when using all these tools, is about, when you use it discretionary, it's about building a story, understanding the story, and seeing what is the most likely step next for that storyline. It's story building. That's what it is. I know that phrase is now often used, but this is really what waves is. It is a continuous development of waves and structures that is being confirmed and invalidated. And each time we see new candles, we get new information. And we can use that to update our most likely analysis, our most likely expectation of the path that we expect. And these tools help us with that. How you use that for trading can vary from trader to trader and from experience level as well. So a more experienced wave trader could really take trades based on that. Could use the entry, stop loss, take profit, all of that based on the waves. Other traders that like waves but are not that keen on it yet, or not experienced enough yet, could use it as a piece of confluence, for instance. So, for instance, rather than taking a short perhaps here, or I don't know, I'm just trying to find an example, but basically you can use the waves to help make decisions at certain spots and try to make better decisions because of that, right? Let's say your system says that you should go long here, right? I don't know, I'm just making something up, just to give you an example. But then you look, you say, wait a second. From a wave perspective, if I look at all these tools in my wave analysis, this could be a bigger reversal. Price has broken below this, broken below the moving average, broken below the key fractals, broken below the trend line. I'm going to ignore that signal from my system as a filter, for instance, right? That would be another way of using it. Or thirdly, you could just use it to understand which fib could be the best, or to get a rough idea about where price is going on a higher time frame, like on a weekly chart, for instance. Like, oh, I think that the structure is, a wave 4 correction, so I would roughly expect a wave 5 to the downside at some point of view. I'm not going to trade that, but generally speaking, I want to keep that, have a certain, you kind of have a bias in mind, but it's based on an analysis, and then you use that on lower time frames to understand which trades might be interesting or not. As just a general kind of for maybe a swing trade that's a bit trying to capture a bigger part of a particular direction, for instance, so you have an idea about where there could be more movement, right? It could be used for stop losses, right? You might look for the invalidation level. It could be used for take profits. It doesn't have to be necessarily for entries. With stop losses, for instance, on the dollar yen, that was clear yesterday, right? Yesterday, I was saying that the wave 1-2 was here, and price invalidated it. So this smaller wave 1-2. But I did say that the wave 1-2 of a higher time frame was this bottom, and that didn't break. So if you're looking for a stop loss on the 4-hour chart, then this would have been the best place to be. The hourly chart, I said that this was possible, and that could help with finding stop loss placements, for instance, or if you're looking for a wave 4. And you see that price is bounced off the 38.2 fib, and you're looking for longs in here, you could put the stop loss, typically below the 61.8, or maybe even below the 50, or maybe even sometimes below the 38 if there's a reaction to it. So because it's going to be a choppy wave 4 and you expect a wave 5, you feel more confident about putting maybe the stop loss there. These are all different ways how you can use it. Wave 1-2, you can put the stop loss below wave 1. ABC zigzag, you can put the stop loss above the origin of wave A. There's a triangle, you can use the lower highs and higher lows. Or if there's a flat, then be careful. Don't use the tops and bottoms because they're vulnerable to be broken in a correction like that. So there are a lot of ways you can use it, not only for trading purposes, just to better understand momentum and correction. Maybe not even to use it for a continuous wave analysis, right? Not always updating each and every wave. But if you see a clear 5 wave that you think, hey, okay, that means, there is a bullish structure here. So after that correction, I could expect a follow through to the upside. Just use it when it's very visible or very clear. And don't necessarily use it each and every time, but only when there's a really clear benefit, a really clear indication, a really clear for you value. Another way of using it. So a lot of ways. As you can see, I just wanted to give you an idea as the last webinar. I think that for the moment, that's about it. I mean, I wouldn't mind continuing in the future with more. For the moment, though, we had these 6 or 7, I believe, webinars focused on fibs and waves. So I hope that helped. I hope it, helped you with seeing some advantages. Perhaps you saw that it's not for you. That's fine too. Or if you like, you can just follow my wave analysis each morning. Of course, small promotion there for my wave analysis with Adamo Markets. You can check it out each day. If you have questions, feel free to use this email address somewhere. I'm not sure why I have it anymore. Probably moved it away, but let me, I'll get it there. But in the meantime, you can check out these webinars. Today, Nenet's taking a look at live trading session, and tomorrow we take a look at psychology. Next week we have more webinars. You can check it out, of course, with education and then webinars. For those interested in this fractal indicator, one more time, you can ask for that simply by sending me an email. Or if you have any questions for the waves, of course, feel free to do that. Oh. Something went wrong. I don't know what. There we go. Bit spaced out because there was some, I guess I have it somewhere, but I'm not sure where it is. So that's the email. Just feel free to write me an email about that, and hope to see you tomorrow, and wish you all great trading, folks. Talk to you soon. Cheers.